meeting. Thanks everyone for attending this event. I don't know why it's kind of posted that way. Thanks everyone for attending the event. We're here to discuss underwriting, understanding the proxy dangers that come along with underwriting and some things of that nature. In the insurance industry and with some of the new insurance solutions, accelerated underwriting has been used to kind of introduce efficiencies into the process, especially with the underwriting process in life insurance. And on the P&C side, it's kind of been more of the underwriting has kind of been married with the pricing also. So when you start to talk about analytics, and I'm going to go with new age analytics as opposed to saying predictive analytics. I'm just used new age analytics, like using those new age analytics. Sometimes individuals kind of get left out. And we define them in our leadership, in our IABA leadership series. We define that as our minority, not in the tone of racial or ethnicity or things of that nature. The minorities, when you hear this discussion, is mainly based on individuals who are not in the target audience. So we appreciate you for attending this event. It's sponsored by Lincoln Financial, but on the other end, it is a collaboration from many of the corporate sponsors that partner with IABA. So we have individuals speaking from Aetna today. We also have individuals speaking from Milliman, and we also have a moderator who is John Watt, and he is from Lincoln Financial. He is the VP. He's the VP and Chief Deputy Underwriter for Lincoln Financial. So we're glad he's here to moderate this session. Just for some housekeeping notes, if you have any questions, you can enter the chat. You can enter your questions in the chat, and the chat moderator will receive your questions, and then she will pass them along to John, or she will just introduce the questions to the panelists. So we're just happy to be here, happy that you're here. Sorry about the difficulties and getting in, but we really appreciate it. So thank you, and I'm gonna pass this on to John and let him get started.
Thanks, Adrian. Hopefully everybody can hear me all right. So I'm John Watt. As Anthony said, I'm the Deputy Chief Underwriter for Life Solutions here at Lincoln Financial. And my group sort of handles a lot of large case underwriting for the company, as well as sets forth the underwriting philosophy and strategy for the Life Solutions group. And with us today, we have three panelists that are joining us, and I'll let each of them introduce themselves, starting with Anne.
Thanks, John. My name is Anne Crumlish. I lead a specialty actuarial organization for Aetna's commercial business. I joined Aetna about 4 years ago after about 20 years in consulting, where I enjoyed a mix of actuarial, strategic, and business leadership roles. I've been a part of the IABA community for over 15 years, and am currently the co-chair of CVS Health's Actuarial Diversity Leadership Team.
All right, Mike, you want to go next?
Sure. Good morning or good afternoon, depending on where you are. I'm Mike Hoyer. I'm a principal with Milliman IntelliScript. IntelliScript is a practice within Milliman that provides underwriting solutions primarily for the life insurance market. So we sell access to data, primarily prescription data, medical claims data, some credit data, and then interpretation solutions on top of that. So clinical rules as well as models that use, we'll call them new age analytics. Is that what we're calling them, Adrian? To assess risk at the time of underwriting. So a lot of experience with trying to understand these complex topics that we're going to be discussing today.
All right, and our final panelist, Eric.
Hi, I'm Eric Kraftcheck. I'm a principal and consulting actuary with Milliman. I work in the P&C space, so most of my experience is related to P&C insurance pricing, particularly on personal lines of insurance, such as auto and homeowners. As Adrian mentioned, on the P&C side, a lot of how advanced analytical techniques have been used. It's been more used on the pricing side of things. So, as you hear my perspective, know that I'll be probably interchanging the terminology a little bit here because I'm used to talking about things from a pricing lens. And that's how, I kind of view things in my world. But yeah, I have a lot of experience on this particular topic and helping companies assess whether or not their rating plans in particular, how they're conducting pricing results in any sort of disproportionate impact on protected classes. So very much appreciate the opportunity to be speaking here and excited to be talking about this topic.
All right, thanks, Eric. And just before we get started, just want to reiterate, if you have any questions along the way, feel free to use the chat room to ask your question, and our Paris behind the scenes will let me know, and we can kind of address them. We want to make this as interactive as possible, so to get your questions answered. But we'll start off with kind of an overlay of the history of underwriting practices and how they've adversely affected minorities. And Eric was going to start us off on this.
Sure. Yeah. So I can give a little bit of historical context to how the insurance industry has instilled practices that might have affected minorities. I think the most tangible example of that is in relation to race, which might not be surprising given our country's dark history there in that regard. If you look back, going back to really the slave trade, the insurance industry, it actually insured slaves since that was viewed as property. And that's really kind of where things started. If you move past the Civil War and past the Emancipation Proclamation, I would say, at that point in time, in terms of the insurance industry's view of race and how they accounted for race in particular in underwriting and or pricing, is that it really kind of mimicked what I would consider, more of the Jim Crow era, where insurers really then were starting to explicitly differentiate prices or underwriting based off of race. And that's kind of where some of that was starting to be supported by actuarial analysis, even though, today we might consider those actuarial analyses to be deeply flawed. So as we kind of move more than into the middle of the 20th century there, that's really when there were a lot more laws that were passed around unfair discrimination, right? And those unfair discrimination laws really framed, how insurers could or could not use certain information. And so most states adopted unfair discrimination laws that said that you can't unfairly discriminate based off of race and other protected classes. And I would say that's kind of when we started moving into what I would kind of consider to be more of the I don't see color kind of view from the insurance industry, where a lot of insurance carriers then, stopped collecting race information. They stopped, obviously differentiating prices or underwriting practices based off of race, and really were kind of using the excuse of, well, I don't have this information, I'm not collecting it, and therefore my rates can't be unfairly discriminatory. And that viewpoint, I think, has largely been accepted by regulators for a very long time, up until, more recently, as we as a society have really started to re-examine, whether or not there are systemic, oppressions that exist in various systems, including the insurance industry. And so now we're kind of moving into a time period where I think regulators and stakeholders and we as actuaries are saying, well, I don't think that viewpoint of saying, well, just because we're not collecting information doesn't mean that there can't be, groups of people that are adversely impacted. We don't think that justification is, maybe no longer supportable just in and of itself. And really, we're kind of moving into this phase where extra steps of due diligence really should be conducted to make sure that practices that are in place don't really result in adverse impacts on certain groups of people. So, that's a really brief, high-level overview of how race might have been viewed in the insurance industry. If you look at other minority groups, though, I'd kind of venture to say that there really isn't much of any anything in terms of how the industry has or has not handled those. And if you look at, for instance, LGBTQ individuals, at least my perspective on the auto side is that there really hasn't been much of any sort of attention given there. And so there really, isn't much to be known right now if there are any practices that could or could not be adversely impacting those individuals. So again, I would say, you know, there's been quite a bit of history on the side of, you know, the protected class of race, but maybe not so much in other areas. And that doesn't necessarily mean that, you know, there isn't anything that should be done or investigated there.
Thank you, Eric. And going along those lines, I guess when we are talking about developing underwriting criteria, are there certain elements that are typically or should be avoided because of it could be a proxy for discrimination? And, you know, particularly to our audience today, maybe from an actuarial standpoint. So Eric and Mike, any thoughts on that?
Sure. I mean, that's where it all starts, right? You have to make sure that there's a differentiation in risk when you add a new underwriting element to the process. And it has to be founded in some sort of reasonable correlation to the insurance practice. Historically, in the life insurance space, that's been a health assessment. So you would either answer a questionnaire on the application, you might provide you know, fluids in a very invasive process. The world's moving much more towards a less invasive process that relies on data that can be obtained electronically, instantly, and be used to make those decisions. I think there's and rightfully so, we should be careful when we take steps towards extracting kind of human judgment from the equation, but we also may overemphasize the consistency of those human judgments in the past. There's a lot of benefit to a systematized approach to assessing risk in the same way each time you're presented with a similar set of facts. And different underwriters may take a different approach to how they would assess that same information. And so systematizing it makes it a little less scrutinized from a person on each individual case, but you can scrutinize the system. And when we start to talk about models as they get more complex, they can be explained in terms that, you know, most folks may not necessarily understand or like. It may not conform to a prior worldview, but they can be explained. So when we're talking about elements that might be serve as proxies for other classes, health conditions do vary greatly by prevalence across different protected classes, primarily race. We know that there's different rates of you know, certain conditions like hypertension or diabetes across different racial groups. There's different rates of taking different medications for members of the LGBTQ community. So there's ways that you could introduce, I would say, some proxies for a protected class. It's a matter of how you use that downstream in order to determine whether it's actually being used in a discriminatory manner. So Eric, do you have others to add from your perspective?
Yeah, I would say on the PNC side, in terms of, you know, the types of information that's being used, it can be a little challenging at times, right? I think as we're trying to find, you know, the new nugget of information, right, that's going to explore or that's going to explain, you know, loss and what's predictive of somebody's driving behavior or maybe how well they keep up their home or something. We're really starting to explore, you know, alternative data sources, as Mike mentioned, and some of those sometimes could maybe not have as clear of like a logical connection to how they might you know, relate to loss. And so there are, you know, maybe some examples there where, you know, it's in terms of whether or not something's a you know, potential proxy, you can kind of get that knee-jerk reaction of, ooh, yeah, maybe that doesn't, you know, sit right. Or maybe something doesn't kind of feel right in terms of a gut feel. And I think an example of that, you know, I was presenting with a regulator actually quite a few years ago. And one of the examples they used in terms of, you know, fairness and ethical concerns was, you know, the number of insureds relatives in a 20-mile radius that has a felony conviction, right? So, you know, if you think about that, right, well, how does that necessarily relate to auto insurance or homeowners insurance? And does it get to a point where, you know, there might be some sort of correlation or proxy effect with justice impacted individuals? So those are, I think, things that are, you know, maybe more directly observable when you're thinking about data and things that might, be proxies. But I would say there are other things that we're using, right, that at this point in time, we might think they might be facially neutral in terms of not having any sort of proxy effect, but they certainly could, right? I mean, if you think about something like telematics, which I think is where on the insurance industry side, there's a lot of support for the adoption of that and using it more, because you're actually then, tailoring that information to the individual driver, right, and getting their actual driving history. But there certainly could be features of telematics in your driving behavior, whether it be the time of day that you're driving and other information that's being captured, that honestly we don't know if that could have a proxy effect. And so I would say that really at this point in time, we as actuaries really should kind of view everything with a blank slate in terms of evaluating and evaluating whether or not there could potentially be disproportionate impacts.
Well, and I think to add to both of those comments, as much as we look at the data and ask whether or not it may be creating bias, I think we also have the opportunity and the as we think about what should we limit, we also, as long as we're consuming all of this data, have the opportunity to use it to check in the opposite direction as well. So as we're consuming all this data, to really ask ourselves, well, when I use that filter, and then come back and apply a filter, whether it's around information we have around LGBTQ, whether it's gender, whether it's race, and really kind of look at that data. Not only can it help us inform whether or not our underwriting and pricing practices might have some implicit bias in them, but I think it can also identify, to Eric's point, other things that may be underlying. I think it probably matters more in a health world where there's coverage rules and benefit design, that perhaps some of those coverage rules and benefit designs could be creating implicit bias and can really sort of be teased out by using some of this data, not necessarily for the purposes of underwriting, but for really better understanding our business and our customers.
Thanks, Anne. And along those lines, do you think there are any requirements around data sharing now that for underwriting practices to ensure there isn't any implicit or explicit bias?
Well, for health insurance, I guess we're fortunate in that space, right? So there's not a lot of opportunity, especially after the passage of the Affordable Care Act. On the individual side, underwriting factors are extremely limited. So it's awfully challenging to sort of insert underwriting bias within the individual space. Within the group space, as Mike was talking about, there is risk because of the way that we use data, that it could result in some implicit bias. But I think that we have to be careful about restricting the use of data broadly within a business, because that same data that may cause bias, we need to not use it in that way, is valuable to be using to understand the business and the customer better. So I think that the requirements on the healthcare side are really clear. The limitations are pretty tight on what we can do, and are certainly intended to eliminate bias in those areas. And I think, at the state level as well as the federal level, there's a good bit of requirements on there. And I think advocacy groups continue to look at the insurance industry and make sure that sources of implicit bias are sussed out. But from a healthcare standpoint, I think it's actually hard within the restrictions that already exist today. It's hard to find anything that is still kind of allowed today that should probably be aggressively further regulated.
Mike, how about you from a life's perspective?
Yeah, so the biggest requirement it would be that most data, if not all data, collected at the time of underwriting for the underwriting use case has to be covered by the FCRA. So it has to be compliant with the Fair Credit Reporting Act, has to be challengeable, correctable by the applicant in the event that it's used against them. And so that excludes a whole swath of data that I think is thrust into the public domain as, you know, concerning for the use of underwriting. And I certainly would be concerned if it was used for underwriting. Things like facial recognition software, social media data, purchasing habits, all of those things. Purchasing habits are very different from credit attributes, which are, you know, acceptable because they are covered under the FCRA. So the big elephant in the room in the life insurance world right now is that credit data and how it's used in the underwriting process. And I think that, you know, we have an opportunity as actuaries and as an industry to, you know, help inform not only the regulators, but the public on how their data is used in these processes. You know, I think when life insurance is a very different world than the health in the property and casualty world. In property and casualty, you're kind of required to have some of those coverages. Healthcare, it's a high use, high touch relationship. With life insurance, it's a one or two time in a lifetime transaction between you and the life insurer. And there's often not a lot of thought given to how that process actually works for the general public. And I think that we as actuaries have a lot of opportunity to help shape how these regulations that are emerging it can benefit consumers, because I truly believe that the use of data in a responsible manner can actually, you know, reduce friction in the process and introduce more efficiencies and reduce prices. It's a matter of educating folks so that it's not a in or out. It's a what's acceptable, how is it used in a responsible way. So that's kind of where the life insurance industry is at right now.
You want to add on the property casualty side?
Yeah, so I mean, I'd echo what Mike said about the Fair Credit Reporting Act. That certainly, you know, has been in existence and is applied on the casualty side. I think it's pretty well known that most auto and homeowners insurers use insurance score, or you call it credit. You know, they use that in rating quite extensively because it has so much predictive value there. I think, you know, beyond that, historically, there hasn't been a whole lot to really govern data sharing requirements, at least as it impacts, you know, the PNC industry. You know, of course, you have your unfair discrimination laws that have provided sort of this blanket protection, but I think regulators have really kind of struggled to assess, you know, as they get all these new third-party vendor data sources, you know, what might be in compliance and what's not in compliance, because they just don't necessarily have the tools or resources to fully evaluate that. I think that's where, you know, the more recent Colorado Senate bill that was passed last year, that's going to go into effect, you know, 1/1/23. I think that's really where we're seeing, you know, the most change broadly across the industry. And I would expect more regulators to follow suit. And for those that maybe are, you know, unaware of what that bill covers, is it's really mandating that the industry is evaluating whether or not there are what I'm gonna call disproportionate impacts. You know, they use the term unfair discrimination in the bill's language, but that definition, or in terms of how they've defined unfair discrimination, it really resembles something that's more classically, you know, would be referred to as a disproportionate impact. And so what that bill really covers is it says that, you know, any insurer that is using external consumer information, so that'd be, you know, data that's coming from, you know, a third party, something that's not really being captured directly from the insurer during underwriting, that use of that information needs to be demonstrated, or it needs to be demonstrated by the insurer that it doesn't result in a disproportionate impact on a wide variety of protected classes that the bill defines. So I think that's, you know, that's where we're, obviously it's where we're heading in Colorado for writers or insurers that are writing business in Colorado. I expect, you know, that to really kind of follow suit in a lot more states, and that will really, you know, require insurers to do a lot more due diligence to prove that there isn't implicit or explicit bias.
Yeah, along those lines, you know, I guess opposed to the group here, what types of regulations are there currently or in the works that might be protecting consumers from any sort of discriminatory underwriting practices? Maybe start with Mike from a life perspective.
Sure. As Eric alluded to, there's long been unfair trade practices laws that sort of govern this, but have never really been explicitly told. Insurers haven't been explicitly told how that might impact them. I think a lot of states and a lot of insurers are watching what's happening in Colorado with a close eye. I think there's a common belief that many states will follow, and some states have proposed very similar bills to Colorado and are kind of waiting how they're going to enact their regulations. California issued a bulletin not long ago about basically saying, hey, there are laws on the books that you need to comply with, and we're going to be asking a lot more questions, is the way I would summarize that type of approach. New York took a very similar approach in early 2019, really focused on accelerated underwriting and trying to, put it out there that insurers are going to have to do more. They never actually proposed a method for demonstrating that insurers would be compliant with any laws. So I think that's where Colorado's gone the furthest with trying to actually come up with a framework that would be able to demonstrate. And I think what Eric alluded to was one of the most important things in that bill is the disproportionate outcome as it relates to the underlying insurance practice. The thing we're faced in life insurance, and I would imagine this is true for health and personal lines as well, is that there are disproportionate risks associated with different members of different protected classes. In life insurance, it's well documented from CDC tables, and there's a great SOA summary of those tables outlining the difference in mortality rates across race. And if that isn't contemplated, you're left with a bar that is unrealistic for the level of risk. And so underwriting is a kind of a blunt instrument to try to treat a broader problem, if that's the route that they're going to try to take, to say, hey, you have to solve these inequities with differences in mortality rates in your underwriting process. Underwriting if you're underwriting to the risk, it's that's the purpose of what you're trying to accomplish as an insurer. But if you're forced to compromise certain things, it's going to change a lot of processes. It's going to change how data can be used effectively. It's going to change how underwriting can be used effectively. So being honest about some of those societal challenges and how they influence underwriting, rather than the opposite, where underwriting being viewed as a solution to a broader societal problem, is I think starting to become more known to the Colorado regulators, and I think they're realizing how complex this all is, with those differences in underlying risk. If they're not present in any sort of analysis that's done in terms of disparate outcomes in an underwriting process, you're not looking at the whole picture.
And I think the healthcare space is going in a very, it's trending in the same place, right? I think the underwriting criteria in a lot of ways have already tightened up a lot. So the risk of implicit bias specifically at the rating point might be fairly minimal. But that broader view of disproportionate outcome and sort of how that insurance product is working. We saw things like the requirement of contraceptive coverage, and we're seeing more around non-discrimination around gender and sex identity. Those kinds of things that are really sort of underlying the insurance product itself. And I think we're seeing both state and federal attention on all of that.
Yeah, I don't have too much to add there. Maybe one other comment is that I think the NAIC is also trying to, kind of grapple with how to kind of make sense of the shifting legal landscape, right? That in terms of how they're reacting to what's going on in Colorado. Colorado's trying to figure out how to possibly implement this bill that they were given by lawmakers there. And I think the NAIC is kind of trying to follow suit with trying to understand this topic more broadly. I don't know whether or not they might issue some sort of, model law or whatnot around this particular issue, but I think it's something that's definitely in the top of mind for a lot of commissioners. It was something that was, discussed over the annual meeting this year, this past summer through the NEIC. So again, a lot of regulatory attention, I think, is being placed on this issue, with regulators trying to figure out how to maybe go about doing anything about it.
Still no questions at this time, but I guess one of our final questions here before we move into the question and answer portion of the meeting is, as companies are using more and more data analytics and predictive modeling in their accelerating underwriting processes, how has that sort of impacted the underwriting practice? Like basically with, companies using their homegrown tools and models combined with external data sources. I'll start with Eric, if you want to go.
Sure. Yeah. I mean, I think this is really, so this is really the question, right, that is like causing a lot of what we're talking about here today, right? Because I would say, the P&C industry has been using, more complicated modeling techniques for a very long time now in terms of pricing auto and homeowners insurance. We were doing predictive analytics before it was coined as data science, right? That was happening in the 90s and whatnot, as insurers were implementing GLMs to inform their rating algorithms. And I think, it makes sense then over time that insurers have gotten more and more sophisticated with how they do their modeling, with the types of data that they're using, because they're trying to squeeze out as much, predictive signal as possible to try to, skim the cream and find the best risks, right? So it's this game where each insurer is competing against each other to see how well they can make use of their data. And that in turn has really led, regulators to question if these filings that are being submitted really comply with their state statutes, right? So if you have, a company that is submitting 2,000 or 3,000 pages of rate filing support for their model and their, proposed rating factors, and they're using a model that the regulator doesn't maybe fully understand, and they're using esoteric variables or esoteric data in said model, how can the regulator actually evaluate and assess whether or not, that model fully complies with their state statutes? How can they, evaluate whether or not that model complies with, their unfair discrimination laws that are on the books? And so I think that's really what got us here. Although I would say that in general, this question of evaluating whether or not there's implicit bias, that would exist whether or not we're using these models or not, right? You could go through and do a very, simplistic analysis on without using some of these models, and you could still develop rates or an algorithm or a process that still could have some sort of implicit bias, right? So I think the difference now is we actually have, power and the tools that we have and the ability to actually go down and do these types of analyses to make sure that there isn't any sort of implicit bias. So yeah, I mean, I would say things have really changed in terms of types of techniques available and types of data used.
On the life insurance side, I would say in the last 10 years, accelerated underwriting has gone from an idea to, the main way that underwriting is done in most cases. Almost every company has some sort of accelerated program. And what accelerated really means in the life insurance world is not having to go through a more onerous process to obtain your coverage. I think they started with trying to replicate what could be done from using data to get to the same outcome. And then I think slowly companies started to realize, well, if we can change some of that and use data in a different way, maybe we can get to a better outcome for more people. And I think that was ultimately the goal of accelerated underwriting, to push as many people through that process as possible without any additional risk to the company. When you start to look at data in a different way, though, you start to introduce, I would just say, things that challenge your conventional wisdom. And that isn't always contemplated, as Eric alluded to, in the old processes. And I think one of the things that I have been encouraging a lot of our clients to do is to take inventory of what their traditional methods have yielded over the years in terms of disparate outcomes for different racial groups. Because I think that's the starting point that companies need to benchmark against and be honest with themselves about, here's what are more traditional things that, the regulators never really asked us to scrutinize. Let's start scrutinizing that so that we're more informed when we go to scrutinize the more advanced techniques. Because assuming that you're getting an equal proportion of applicants converted to insureds is simply not going to be the case when you start to do those types of analyses. We have done some pretty interesting analyses that take that view of if we look at a client's current mix of business and then try to layer in, step into, hey, what if we just introduced a predictive model that looks at medical information? So nothing that is under the purview of Colorado, at least from a life insurance perspective. They've kind of given a safe harbor to any model that just uses prescription data or medical type data. Let's see how that changes how many people could have been issued. And we see an uptick in terms of all racial groups being offered more opportunities for coverage at no additional risk to the insurance company. We add in credit data and that number jumps even more. And we've found that to be a pretty insightful way of looking at it. But I'm very conscious of the fact that every company is going to be starting from a different point. You might be starting from a place of, really fine tuning that mortality assumption versus, hey, we've got a lot of room to a lot of margin in our mortality. Maybe we have to, look at it a little bit differently. So if you're on the edge, credit data may not help you very much at all, and in fact may take you backwards in terms of introducing more proxy or more unintended discrimination. But if you're starting from a place of not having as mature of a mortality assumption, maybe like a simplified issue, or you're in the early stages of launching accelerated underwriting, you're looking to expand that, these new techniques and new data assets can really accelerate sorry to use a pun on the accelerated underwriting, accelerate your path to offering coverage to more individuals.
I can say from a life standpoint, especially, after the COVID pandemic, a lot of carriers have really stepped up their movement into accelerated underwriting. And I guess just one more question on that is it's definitely probably improved the customer experience in terms of, making insurance a much easier process. But in that, do you find that maybe has it made insurance a more inclusive endeavor in that regard?
I think companies need to start measuring that. I don't know if the answer is definitive one way or another. I think that whenever you start to introduce new processes, you have to be conscious of there's going to be a different outcome. And I think, like I was alluding to earlier, let's say you had a target acceleration percentage of 10%, and adding an additional requirement like credit data could take you up to 25%. I would say that's generally going to be more inclusive to all groups. But it's not definitive. You have to do the work. You have to do the analyses to prove that before you launch something like that. And I think we're getting to the point where you can draw those high-level conclusions with some publicly available tools to make those assessments and at least be more informed than you were yesterday when adding some of these data types or advanced analytics into a process.
I think
so I gave you the classic it depends answer, John.
Yeah.
I think one thing to maybe add there, and again, this is coming from a PNC perspective, so I'm not sure, how much this might apply to some other disciplines and other lines of business. But I think one thing that's important for us to remember in the insurance industry, especially if we're talking about like inclusivity and doing analysis based off of data that we have, is that our data that we have might inherently already be biased, right? So to the extent that we have underwriting, rules or practices, pricing practices that are, effectively weeding people out, right? Weeding out certain individuals from getting coverage, and therefore being kind of excluded from the data sets that we have. that could certainly potentially impact any analysis that you're doing in terms of inclusivity or exclusivity. So I think that's something that's important to keep in mind, not only for that question in general, but even, also even just kind of looking more broadly at, implicit bias.
Thanks, Eric. I guess I'll just check with the audience now if they have any, questions they'd like to ask the panelists here. I don't see anything yet. I know we're coming up on time here, so I just wanted to do a check. Doesn't seem to be any questions from the audience. Adrian, is it our time to wrap up now, or?
Yeah, we can wrap up. I would like to say thank you to all the panelists. Thank you, Mike. Thank you, Eric. Thank you, and also to our moderator, John, and thank you to our project manager, Deanna Wade, and also to Paris. I would like to say thank you also. We've heard a lot of information related to underwriting and some of the things that are going on, and it's going to have me go back and check on this Colorado bill, because I didn't know anything about it and what's going on in California. I was kind of aware of what's going on in New York, but I wasn't quite aware about what's going on in California. So this is California and Colorado. So this gives me an opportunity to freshen up on what's going on in the world around me, especially related to underwriting. I think data has become a hot topic in every industry, and we're happy to see that the insurance industry is using the data, but we also want to make sure we're doing our checks and balances. So thank you to all the organizations that participated in this event, and thank you to everyone who came, and I'm happy for everyone that showed up and listened, and thank you to the panelists again. You did such an amazing job, and sometimes it may have been on short notice, but you did such an amazing job, and you discussed more. You gave me more than I was actually looking for. So thank you again, and thanks to everyone, and I hope you have a great Tuesday.
Thanks for the opportunity to join. Yeah. Take care.
Thank you.
Bye.